Hey guys, today we're going to talk about debt ratios in companies and debt covenants. We're going to have to go to the laptop here in a minute. This is a follow-on to the PE ratio video from a few days ago, basically the one about price is what you pay, value is what you get. Well, if you found good value, it doesn't necessarily mean you have to buy it. And there are still a few checks you should run. The number one check is how much debt the company is carrying. Because in some cases, they might actually have more debt than they do assets, and that's not something you want to necessarily buy into. That's like getting into business with your brother-in-law that owes more money than he actually has. You're just buying debt and then assuming responsibility for it. So we're going to take a look at that. We're going to look at a couple of metrics for how to figure out debt. And we're going to look at two places to validate what those debt numbers are. We're back on TradingView. I have the same three stocks open on a different tool in TradingView. This one's the screener. And we're going to take a look. So starting with Cogeco here, after you've looked at your PE or your value that's built into the price, you want to take a look at debt, okay? And you want to look at just net debt and also debt as a ratio. And when I say net debt, I mean what they have versus what they owe or how much cash they could put down on it. But then debt to equity. So if they sold everything, how much debt would be left? Ideally none, and they'd have money left. But sometimes that formula doesn't work. So in this case, we're going to focus on that. As you see here for Cogeco, which earlier was our, let's call it our better bargain or our more value for our buck in terms of the price to earnings. In this case, they have a debt to equity, which by the way, you find this when you go to balance sheet. They have a debt equity of 5.12. That's really not good. It's somewhat overextended on debt. Now, when I find numbers like this, I tend to go validate to a second source because I'm always worried that perhaps the synchronization between TradingView and the source might be wrong or that an error may have occurred. So I'll screen it here and then always go validate. Even if it's a good number, I'll still make sure that there's no mistake made just by checking the 10Q or 10K filings directly from the company. But debt to equity of 5 means that they owe about 5 times more than they're worth. That's really, why would you buy that? You're basically assuming someone else's debt when you buy this. We'll get back to that. Now, if we look at BCE, Bell, they have a debt to equity of 1.79. It's better than 5, but it's still above 1. Ideally, this is below 5, and even then below 3 would be even better. This means, again, you sell everything off, there's still money owing. So not excellent. And then if you go to Rogers, we're at 4.33. So they all passed my first check of price to value, and Cogeco ended up with the better value. My second check is how much debt do these guys have? How much debt would I be assuming in buying them? And what if they shut down and sold everything? How much money would I be left? In this case, all of them I'd be left with absolutely zero because creditors would be paid first and there's nothing left for the shareholders, which is, quite a bit of risk. Not that it's super risky in the context of these giant telecoms, but still, it's not where you want to be dabbling. So the important thing about the debt to equity ratio is that there's something not spoken here beyond the numbers, and that is that companies have debt covenants. Okay, these things, and I might try to put a couple on screen as we go, will have either positive or restrictive annotations that imply certain events will happen if the debt ratios or the debt threshold crosses a certain event. So a big bank might lend Rogers or Cogeco an extra, let's say, billion, but they'll say if your debt to equity ratio goes to 6, you need to pay us back X amount, or you need to give us a bunch of shares, or whatever the covenant might be. Okay, there's all kinds of stuff. This in turn ratchets the company's ability to do business. Usually it tightens the screws on them, so to speak. So, and not to mention that in today's market, interest rates are going up, so that debt and maintaining this debt is actually costing these companies more and more and more and more. which is eroding their profit margins and potentially sending them towards a very tight spot where we saw Bell recently close, I think, 45 radio stations and lay off 6,000 people, right? Whether it's because of debt or just usual business decisions, that's fine. It's out of my hands. However, it's putting handcuffs on the company's upper management to make decisions that are in the interest of the shareholder. So in this case, all three of these companies would not make it past my second stage of vetting because of their carried debt. I think it was Christopher Reeves who said, debt is like cancer. You want to avoid it as much as possible. For Peter Lynch, he said you want to find a company that has zero debt because you can't go bankrupt without any debt. Other famous companies that have gone defunct because of very high debt loads would be Bed Bath & Beyond, and if you go back about 15 years, a company that was seemingly unstoppable for a while, Blockbuster, right? They ended their run well below how much money they owed. So this is the next thing you want to watch out for. I hope it helps make a little bit more sense. So you figure out your value, you want to find something that has good value for the price, but then you want to figure out how much risk you're taking and how much debt you might be assuming. So in the next video, I'll look at a few more of these points, but I'll leave you with this for now. Comment below if you have any questions. All right, that's it for debt. I hope this one was informative. As a follow-on, there's going to be more because these are definitely not the only metrics to look at when you're looking at stocks. But yeah, hopefully this filled a gap in the knowledge, and I'll keep them coming. Thank you.